After a banner week for stock market bears, we'll review the latest charts to help us get a better understanding of what could be next for stocks, bonds, and gold. This week is an outstanding example of why we continually say in these videos that we're making probabilistic statements about the facts that we have in hand. And if the facts change, we have to be willing to reassess the probabilities. We'll be moving quickly this week, so if you want to review some of these slides in more detail, feel free to use the pause button on your video player. Before the stock market opened on Monday of this week, we said our bird strike procedures might call for some profit taking. This screenshot from Bloomberg pretty much sums up the historical week. We just witnessed the fastest stock market correction on record. S&P has fallen more than 10% from its record high, and it only took 6 days, the quickest plunge in U.S. stock market history. How does this week's historic plunge impact all of this? Is it possible the bullish case, the bullish long-term case, is still intact? The answer is yes. Remember, we talked about several times that cyclical periods within secular trends can be marked by painful pullbacks, serious corrections, recessions, and bear markets. And this week drives home the importance of being willing to understand a wide range of outcomes. Secular trends can produce stunning returns. There can also be extremely painful pullbacks along the way. Here's the strongest part of the secular trend. Starts in 1950, goes to early 1966. This is a big move. This is a painful drop, a painful drop, a painful drop, and a fourth extremely painful drop. Secular trend that began in 1982 lasts all the way to the year 2000. A lot of pain in between point A and point B. Typically during a secular trend, the market makes a stand above or near an upward sloping 200-week moving average. Given the look of the same chart on February 27th, it's very, very difficult to say that the secular thesis needs to be watered up and thrown in the trash can just yet. But that will fall into the to-be-determined category. And if you think this week was bad, we should keep in mind that in 1987, the S&P 500 lost 20.47% in one session. And that one-day drop here occurred within the context of a secular trend. The current leg of the secular trend, typically during the stronger parts of the trend, we make a stand at an upward sloping 90-week moving average. We did close above the 90-week on Friday. This is simply a bull-bear reference point. You can pause your video player. Fastest ever. Sentiment trader, this is the fastest the S&P has ever wiped out 4 months worth of gains after hitting an all-time high since 1928, and that spans 92 years. Terms like fastest ever and never seen before are why we have a bird strike manual. We implemented bird strike this week. Let's talk about the basic objectives using the plunge in 2018 quickly. During the early stages of a plunge, we want to identify risk factors, basically saying we're really not expecting to see this right now, and we need to make sure we have a very specific plan in place if things get worse than expected. Since in this area here, we are trying to balance the desire to stay invested during favorable long-term trends with the need to protect profits during lower probability events, our goal is only to mitigate some of these declines here and reduce our risk exposure in the event that the correction morphs into something that is much worse than expected. In somewhat of a second leg down scenario, you want to significantly mitigate the losses in here. You want to have cash on hand. It's much, much easier to keep an open mind when you own some stocks, some bonds, and you have cash and gold, putting us in a much, much better spot to identify signs of a possible reversal, increasing the odds that we are market leaders in here after the reversal rather than market followers. We don't know what the economic data is going to look like, so the mitigation strategy here, this is somewhat like the present day, could potentially pay off if the economic data tends to be on the weaker side, as this data was here that was released after the close on Friday. If we do all of this in here, And we're in good shape mentally and from an allocation perspective. If this, or even this, morphs into something really unexpected, it could make a big, big difference relative to real-world historical drawdowns. We'll walk through very quickly. Assuming we had $1 million here, would have been really, really helpful in here to have your bird strike plan in place, because your $1 million in 1961 would have dropped to $720,000. And you can review each historical case, the year in the upper left, the real world drawdown, what $1 million would have turned to as I scroll through each one of these real world cases. Even before we had bird strike procedures in place in the real world in 2018, totally out of the stock market here. The market hypothetically went to here if we saw a loss, peak to trough loss, similar to what happened in 1929. So let's quickly walk through and summarize the basic concepts relative to what we did since last Friday's video and this Friday's video. Why do we even have a bird strike plan in place when the market opens on Monday morning? We're just 2 days removed, as of Friday's close on February 21st, a week ago today, from a new all-time high. The plan is put in place because we have divergences. We have volume issues in here, and we know the coronavirus is a concern. So if we walk forward from Friday's close a week ago, February 21st, to Monday, February 24th, what are some of the things that we saw that said, we need to have a bird strike plan out and we need to start executing? We get an ugly, ugly gap down, heavy volume. This is a large percentage decline relative to what's happening in here. And now we have what appears to be a failed breakout, and really a second failed breakout, because this breakout failed as well. There's a long list of things to look for. This is just a handful of examples. So while everything looked pretty good on February 21st, there were some concerns, and we were only 2 days removed from a new all-time high. We began harvesting and protecting profits during Monday's session on the 24th. And all of this really doesn't mean anything when we see all of this in front of us on Monday morning. Because as we say in these videos all the time, we don't make any decisions based on historical studies or historical precedent. Because all of this is simply a reference point or context for the facts that we have in front of us. We always make decisions based on the facts in hand in the present day, and we always trade the chart in front of us. This is the October low last year. We're not bullish and invested in this area here because of historical studies or historical precedent. We're bullish and invested in here because of the facts that we have in front of us here. Here, the facts are starting to change. And remember, we have to balance the desire to protect profits with the desire to stay with the existing trend. Thus, relatively muted response here from a profit-taking perspective because we have areas of potential support below. Then on Tuesday, more significant deterioration causing us to start to move away at a faster rate. We move away at a rate that's in line with the deterioration in the weight of the evidence. This is Tuesday's session. We still have some reasons to believe the market could at least balance. We want to balance the desire to stay with the existing trend with the need to protect profits. When we saw something like this, it became reasonable, and we wrote on short takes on Tuesday, February 25th. Wouldn't be shocking with this to see the S&P 500 pull back 12.88% to roughly 2950-ish. As it turns out, we closed Friday at 2954. This is Tuesday's close. We're implementing bird strike on Monday and Tuesday, protecting profits. Wednesday's close, it looks like the market's trying to make a stand at a logical level, and we do nothing. Trying to balance the desire to stay with the trend relative to the need to protect profits. Thursday, we get more ugly and somewhat unexpected information relative to what we knew over here, and hence we're starting to move away at an even faster rate. At this point, the market has shown us nothing. We're always trading the chart in front of us, not the chart we want to see tomorrow. Profit taking Monday, Tuesday, skip Wednesday, and again on Thursday. Friday during the session, we don't see anything until relatively late in the session, more profit taking. We can always redeploy the capital quickly as long as we're willing to push our ego aside and maintain that all-important maximum flexibility 100% of the time. Just some more visuals to understand the concept of balance. Tuesday's close. We're at areas that could act as potential support. But we still have this look here that's concerning. You go lower, you go lower. Wednesday, not too bad. We're patient. Thursday, the market gets hit with the ugly stick again. Not a good sign that the market is blowing through these areas of potential support so easily. Friday's session during the day, we're still in free fall. And we end up closing right around area 2 that we talked about in short takes on Tuesday. Other than somewhat holding in this level, the market has really proven next to nothing so far. That could change as soon as Monday morning, but it hasn't changed yet. Our mindset here would be similar to our mindset here. We're open to a wide range of outcomes, but the market needs to prove it. One of the key tenets in bird strike identification, based on studying every single trading day going back to 1950, is failed breakouts. We have 2 of them now. Corollary: the longer a market goes sideways, this is 2017, this is 2020, the longer a market goes sideways, the more concerned we should be if a major breakout fails. Is it possible that we get a V bottom here? Absolutely, positively, yes, but the market needs to prove that to us. Even intraday, when you're implementing, all of these charts were marked up on Sunday before the market opened, or some of them were marked up literally months ago. So when we come down in this area intraday, you try to be patient. And here's the close on Thursday. That is not a good look. This speaks to some type of serious concern. This speaks to some type of serious concern. A handful of good things from Friday's close, not a lot. This is still a terrible look, but we did close near the session high, which is quite a bit better than these days up here. Baby steps. Be moving very, very quickly. We just said failed breakouts. Not a good thing. If you know technical analysis, this is the look you want. This look here should make you cringe. Bank ETF, KBE, a week ago Friday, up here. Thursday's close, not a confidence-inspiring look. Friday's close is not inspiring confidence. The market needs to prove it. It may do so very soon. It has not yet. Once again, visuals for balance. Wednesday, February 19th, things look good. A week later, still not that bad. You can make an argument this looks like a retest of the breakout. At the end of the week, somewhat of a balanced look. This looks terrible. This failed breakout, very concerning. But we do have some potential support here, and we might get a bounce. Most of us know about breadth thrust in a bullish manner. And the breadth thrust that we wrote about on short takes in January of 2019 proved to be extremely helpful. It's also possible to see bearish breadth thrusts. Percentage of NYSE stocks above their 50-day exponential moving average. Bullish scenario. It can mean oversold. We move from the top line to the lower line, near the low. 2002, big rally, walking forward. 2011, move from here to here. Rare, oversold look. After that, good things happen. You can make an argument the present day look is similar. Unfortunately, you can also make an argument that this move from here to here could be the early stages of a new trend. just as the breadth thrust that we wrote about here in early 2019 marked the early stages of a new trend. Present day look, top blue line, really fast to the lower blue line. Here, really fast move. Look at that and compare it to that. Come down here, this is what happens next in the stock market. Simply telling us to keep an open mind about a wide range of outcomes. Oversold can be bullish. Oversold can be the early stages of a new trend with a lot of bearish momentum telling you are going to fall much further. We have shown numerous examples of hard evidence that tell us it is prudent to try to mitigate, balance, and protect. It's very, very easy to get discouraged after a big drawdown. That can be a big, big mistake. Why? Because it's distracting. We need to focus on the chart in front of us and continue to execute. This is the close on Friday, February 28th. We are only 6 trading days removed from this peak. And you can make an argument that we have a breadth thrust similar to this area in here. Hypothetically, if we were at the early stages of a new downtrend. This is about 6 days after the major peak in the S&P 500. Why was it important to stay focused and not be distracted with the rearview mirror? Because from 6 days after the peak, the S&P 500 lost an additional 56%. Based on the facts that we have in front of us, prudent to try to mitigate, balance, and protect. Same situation if we get a bullish outcome. If we're feeling sorry for ourselves here, or we're distracted with the drawdown here, and it was only 6 days after a major oversold low in 1987, we might have taken our eye off the ball and executed poorly. Even the 1987 drawdown really looked like a blip on the radar a few years down the road. Open to all outcomes. Trading the chart in front of us, staying in the now. Because dislocations in markets, we just had one, bring opportunity. If we stay focused, the odds greatly increase that we will differentiate, identify, and capitalize on the most favorable opportunity. That opportunity could be in stocks, it could be in gold, or it could be in bonds. Once again, we all know what oversold means. Oversold here means we should be buying. Oversold. Rare oversold. This is the present day here, February 27th. Have to keep in mind, it doesn't necessarily mean we're near the end. Here's a move from the blue line to the blue line. Here's a similar move from the blue line to the blue line. Look where it occurs, right here. Not a prediction. Because good things can happen too when you're oversold. Good things can happen when you're oversold. But you don't see a lot of press and coverage of bad things can happen after a bearish breadth thrust. Rare, oversold, this is what happened. Rare, oversold, this is what happened. Rare, oversold, this is what happened. Not a good look here. It's not oversold. It's not over. Maximum flexibility. Rare oversold. 6 days after a peak. Similar situation here. Ratio adjusted McClellan oscillator. Rare oversold can mean we are near a bottom. It can also mean we're not near a bottom. We don't have to go back very far to see the McClellan oscillator drop and then really bad things happen for a long period of time. We have numerous facts in hand that told us on Monday morning this week that it was prudent to start to mitigate, balance, and protect. Can't emphasize enough, the purpose of this chart is not to say this look is bearish. It can be extremely bullish. The purpose is to say we shouldn't try to predict what this means. We don't need to predict. If this is bullish, the market will show us bullish signals. If this is bearish, it won't. This helps us trade the chart in front of us walking forward, respecting the potential for bearish outcomes. This chart here tells us to trade the chart in front of us walking forward with respect for better than expected outcomes longer term. S&P 500 yield minus the yield on a 10-year treasury. A way to look at stocks versus bonds. When we were up here, this is a new high. This is a new high. We just made a new high this week. This point here is similar to the present day. This point here is similar to the present day. In both cases, it was prudent to mitigate, balance, and protect for some time. Mitigate, balance, and protect for several months. Maximum flexibility, trade the chart in front of you, because then really good things happened. It's extremely rare to find a look like this. This is almost a mini 1987 look. The decline, not even in the same league with 1987, but it could be a fractal. Go back and look on a weekly chart and see how many times you can find a look like this at the end of the week. And I'm talking about a look with a big gap that you could see from across the room. This is intense selling pressure. Monthly, gold versus the NASDAQ 100, Friday's close. We own gold and we own tech stocks. No bias here. If you really want gold to run versus tech stocks, this is the look that you want. Above an upward sloping 50-month moving average. You want MACD to be above the center line. We're not quite there yet. We may morph into a look like this. This is an improving look. This is weekly gold versus the NASDAQ 100. See this move here? It never really materializes into much of anything for gold. You can make an argument this look here is similar to this look here. If gold is going to kill tech stocks, we need to get over here. This is Thursday's close. This is Friday's close. Most of our accounts have some relatively small exposure to gold mining stocks. Why not more exposure? This is Thursday of this week. We need to see this chart get over here. This is Friday. Right now, it looks more like this than this. Similar situation here. Gold, S&P 500 last Friday. This is the type of look that we want. We don't have it yet. Thursday, we're getting closer. Friday, balanced and measured approach. This is why some of the tweets this week were like coffee grinds. If they appeared indecisive, there's a reason for that. It's hard to determine right now on Friday if you want to be adding to the S&P 500 or gold. Last time this ratio was here, it went like this. Last time it was here, it went like this. This is a bullish breakout. We need to see step 3 and get into this area here. It may happen very, very soon. Bird strike on Monday, measured and balanced approach. Why? Looks like we're near support here, that this is a retest of this breakout. This is Monday. You can see why bird strike was implemented on Monday, on Wednesday, and on Thursday. This is a failed breakout look and concerning. This, concerning. Similar concepts here, stocks versus bonds, Wednesday. Resistance, 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 same general area. Stock market here, resistance, stocks do well. Resistance for bonds, stocks do well. Indecisive look on Wednesday. Friday starting to look a little bit better for bonds, but this is resistance here. We haven't cleared that yet. How we handle stocks versus bonds going forward could be radically different based on what happens on this chart. S&P 500 weekly, February 21st. Friday's close, we have that failed breakout look, and we are also below the 50-week moving average. That's not what a strong secular trend does. Tech versus bonds, 7 trading days ago, new high here, holding a breakout, February 19th. Friday's close, now we have a failed breakout look. Anything else telling us we should be or should have been mitigating, balancing, and protecting? Yes. Here, the evidence aligns with the bullish thesis. Here, failed breakout. The evidence contradicts the bullish thesis in the short run. Short-term VIX versus intermediate-term FIX. Spike here. You are near a low. You are not at the low. Spike here. You are near the low. You are not at the low. This low forms months later. Spike here. You are near the low, but you are not at the low. This one has a retest. This one has a retest. And this one has a retest. Does that mean this one will have a retest? Absolutely, positively, no. We will be trading the chart in front of us, not necessarily waiting for a retest or not waiting for a retest. The longer a market goes sideways, the more concerned we should be about a failed bullish breakout. Value line geometric index, Thursday close. Tech versus bonds this Monday. This is why we have a measured approach on Monday. This just looks like a retest of the bullish breakout. Why did we implement additional bird strike steps during the week? Numerous reasons, including the fact that this now looks like a failed bullish breakout. Growth stocks versus bonds, bullish breakout. Earlier in the week, it looks like a retest. Thursday, not looking particularly good. Friday, the negative part. This is a failed breakout. This is a miserable look here. The ratio did make a stand here, and it did make a stand here. Why were the tweets a little indecisive? Because the look of a lot of the charts have been indecisive. Is it time right now to go out and sell everything and buy bonds? That's a personal choice, but under our approach, we know that that ratio reversed here. It reversed here. Haven't hit that area yet. There is one difference, though. You don't close in the area here. You hold on the top line. Here, you close on the top line. This is a small difference, but this looks worse. And if you flip forward one day, it gets even worse on Friday. Notice here, do you see anything below this line? No. Anything below this line? No. This is a very subtle look. We presented this chart back here in 2019 and said that this look here was similar to this look here. This is 2012. Similar to this look here. This is 2016. Here. Do these facts align with or contradict the bullish thesis? They align with it. These facts contradict the bullish thesis. Hence, a reassessment of the probabilities. Tech versus bonds. Every single one of these lines was drawn months ago. Thursday, still taking a measured approach. During the week, taking a measured approach because we haven't really failed yet. But we have seen this. Once again, it's a subtle difference. If we look at this, and if we look at this, and even this looks worse. Remember we talked about ADX and sleepy trends. Now with a failed breakout look. If we hold a failed breakout look, ADX black below both green and red. This tells us now, if red moves in this direction, that this is a sleepy trend, and this could tell us this is the early stages of a bearish trend. It's not a perfect tool, but this is a sleepy trend look, and the failed breakouts in this say open mind, maximum flexibility, could still go either way. There's a big difference between worrying about being right and getting it right. If we want to get it right, we have to be extremely nimble walking forward. Forget the last trade. Stay focused. Don't assume anything. There's evidence that says things could get worse. There's evidence that says we could be near a low or at a low, and things could get better. When we sit in the money management chair walking forward, we don't care what we look like here. We just want to get it right. Get on the right side of the trend. Get on the right side of the trend. It might be messy in here, but allowing a messy trading pattern and having maximum flexibility greatly increases the odds of staying aligned with the trend. The charts that we've reviewed this week tell us most likely there is an opportunity coming in either the stock market, the bond market, or the gold market, or maybe two of the three. The only way we can execute properly is to head into next week and every week with that flexible, unbiased, and open mind. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or an offer to buy or sell any securities or any related financial instruments, nor should any of its content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shavaco Capital Management LLC or CCM is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.